Hello friends, welcome to Price Action with Prashant. I am Dr. Prashant Parate. I am an orthopedic surgeon with keen interest in shoulder and knee surgeries. I am passionate about technical analysis based on principles of Wyckoff's analysis. I am not a SEBI registered analyst or advisor, and I am not financial advisor for anyone. Whatever I am going to discuss in these videos is for educational purpose. It should not be taken as a trade advice. Trading and investment are subject to market risks, and you are requested to use these methods discussed in these videos just for analysis purpose or for paper trading till you become expert. Do not trade with real money without understanding the underlying risk. Please take responsibility of your own decisions and actions. This is first video on technical analysis course. We are going to discuss about market structure, and it is most important aspect of understanding price behavior. This diagram shows basic outline of price behavior. As described by Wyckoff, there are 4 phases in stock life cycle, where stock prices rise and fall frequently due to actions of market participants. These 4 phases are shown in this graph. Accumulation phase is a phase where major investors accumulate their stake in good companies at cheap rate. This is usually a trading range area, which may be very big area. Sometimes top of the range may be even 100% more than bottom of the range. That means bottom can be at 50 and top can be at 100. And many people are content with trading just this range, aiming for probably 10%, 20% gain, or sometimes maybe 50% gain. Once accumulation phase is complete, then there is a markup phase, where prices start rising due to multiple reasons. Main reason is those people who have accumulated shares want profits, and they want to sell their stocks at much higher rates. Otherwise, they won't make any profit. So first, they acquire large quantities of shares and diminish supply in accumulation area. Then, as supply is reduced, they increase prices in markup phase, so that other people should also get involved. As lot of people start developing interest, share prices start increasing in markup phase. From accumulation, prices increase up to distribution phase. There can be smaller trading ranges again in markup phase here, and it's called as reaccumulation, as stock cannot keep rising one way. They have to take pauses. So this is reaccumulation phase, where there is a pause for some time period before starting upward journey again. It can be horizontal trading range, wedge shaped or triangular trading range. It is also called as time correction by some people. Prices keep moving higher with these structures, and paper profits of investors keep increasing along with share prices. Then major investors start to dump their holding at very good profits when they feel there is not much growth left and some other opportunities are available. They may dump shares at once or gradually and form distribution phase. There is lot of supply in distribution phase, which is provided by market makers who have fulfilled their targets and they want to sell in huge quantities. In distribution phase, there is no major interest left to take prices higher, and big investors are not available who can use their money to buy large quantities at higher rate. So after distribution, due to lack of buyers, share prices start falling. Unless there are fresh buyers, share prices do not increase. In some stocks, it may be because of short selling. Once there is distribution, people may start selling for shorting opportunities. But many times it is because of lack of buying interest. If there is lack of interest by big institutions who can support prices and increase the prices, there can be rapid fall and big fall. So during liquidation phase or markdown phase, there can be redistribution after primary distribution is completed, and it is similar to reaccumulation after accumulation. So this is very basic idea of market structure, where there is accumulation, markup, distribution, markdown, and again accumulation before further rise. These phases, while getting accomplished, move through different market structures, which we will learn over few days, and we will learn how to use swing high, swing low, trend lines and trend channels to understand bullish or bearish behavior of operators or probable lack of interest of operators. These phases can be identified in all time frames, right from 1 minute chart to 1 month chart as well. In higher time frames like monthly or higher chart, it takes lot of time to develop, but it happens. It is very easy to identify these phases in daily chart and lower time frames. Even weekly chart sometimes takes months to years for completion of accumulation phase. These are 4 simple phases of market which we have seen: accumulation, markup, distribution and markdown. Accumulation and distribution are usually trading ranges, like we can see here, it is a trading range. So accumulation and distribution are usually trading ranges which either lead to upside breakout and markup phase or downside breakdown and distribution phase. They are a type of reversal pattern with chances of good success rate if we can identify some settle points. They provide good opportunities for investors as well as traders. We can see them on many charts very easily. Now let's come to chart. This is weekly chart of escorts. Here we can see there were different phases visible which I have marked. On extreme left here we can see there is rapid fall. This rapid fall was the selling climax, and it was followed by accumulation for few weeks before going higher, and it gave lot of time and opportunity to buy. Whenever there is a rapid big fall, stocks usually goes sideways phase for trading range, and it gets accumulated before going higher. It gives lot of time and opportunity so that we can buy, and we can buy shares when they are ripe to go up instead of trying to catch a falling knife. After rapid fall, there was accumulation which was followed by markup. So this is rapid fall, selling climax, accumulation and then markup phase. So these green lines are showing fast movements. This markup phase is good for momentum trading. Then there was upsloping distribution. Here we can see there are sideways as well as sloping trading ranges for accumulation as well as distribution. So this is upsloping distribution. There are few patterns of accumulation and distribution which we are going to study with time. But after this distribution, we can see there was a markdown phase where we can see there was a rapid fall. And how much was this fall? From this top to this bottom, there was 80% correction in price. So it eroded lot of time and price. This hampers speed of compounding. Stock was down by 80% from this top, and it came back to same level after 2000 days, means almost 7 years. It took 7 years to come back to same level. Even though stock has given 6.6 times return in 11 years from this top till today. Today chart is not visible here, but it has given 11 times return, and it has given 19 times return after markup phase started from this second accumulation. So this was start of markup phase, and from here it has given 19 times return. This return is in less than 10 years. So there is significant difference. Return is faster in less time. After this markup phase, there was again reaccumulation and momentum phase. This was markup phase. Big money is made by sitting, but we should know appropriate time to sit. Otherwise, it destroys wealth as well as patience. Even investors need to have good entry and exit points to maximize gains. Usually, accumulation ranges are longer than distribution ranges. Accumulation takes time because people want to buy at cheap rate, and huge quantities buying will increase the prices. So they accumulate slowly. Distribution on the other hand is faster many times. But this is not a rule. Sometimes accumulation can be done in smaller time frame and distribution may take longer time. Longer the time taken, larger is the effect. It is cause and effect rule of Wyckoff's principles. Now let me ask you all, why is market structure important? Market structure is important to understand underlying trend. It is said that trend is your friend. It is well known fact. I have lost lot of money by trying to find out reversal against a trend. Trend identification is of utmost importance and following the trend is equally important. Most money is lost in trying to find out top and bottom, and it will remain so forever. This has been since ages. Human mind works like that. Mind gets pleasure by buying at bottom of a downtrend and selling at top of an uptrend, which may happen once in 500 trades if done randomly, maybe 2 times in 10 trades by best of the experts. That means 8 times trend reversal fail. Trend reversal has 80% of failure rate. Many people can buy at bottom, but it is mostly for mean reversion trading, not for trend reversals, and they book small profits in those trades. However, it is far more rewarding to take trade in direction of dominant trend, and even without entry at bottom or top, one can make very good profits with high success rate. Market structure helps in identification of best direction to initiate particular trade, as well as sweet spots where we can lean against a market structure to have added conviction for trade. Market structure also helps in identification of trades suitable for underlying market condition. It gives us idea whether we should look to trade or stay away. So these are takeaway points for market structure which are very important. Please remember them. Unless market structure is understood properly, no matter what we do, trades will have just 50% success rate. Trading is contextual and we need to understand underlying market conditions to understand bias. There are multiple trade setups based on indicators. These indicators give beautiful results sometimes and they fail miserably sometimes. Reason for this is failure to understand market structure. If indicators are used without understanding market structure, they are bound to fail, and if indicators are used as an adjunct to market structure, results will improve. There are thousands of indicators available, but without understanding price action, one may not be successful with just indicators. Now, why we are learning market structure first? Market structure is most important aspect of technical analysis based on price action. In our course, we are going to learn lot of things. We are going to learn right from bar by bar analysis, volume analysis, trend continuation patterns, trend reversal patterns, springs, upthrust, test, different types of test, entry points and exit points, target calculations, and many more things. Most important of them is market structure. We could have started with understanding of candles and bars, but I found this approach is better. First, we will discuss structure where we have basic context ready and we can have all analysis which will be easier to understand based on structure analysis. First part of market structure is trend lines. There are different parts included in trend lines. I had covered basic portion on trend lines earlier. We are going to cover more details on trend lines now, right from beginning. We will consider all these things in trend lines, which include horizontal support and resistance, as well as simple trend lines. Simple trend lines means sloping lines where we have support line. It is also called as demand trend line, or resistance line, which is also called as supply trend line. Then we will study how to draw trend channels by taking a line parallel to either resistance line when going down or a line parallel to support line when going up. So these trend channels are very useful and we will see how to use them. Then we will see reverse use of trend lines, and very important aspect, confluence of horizontal and sloping trend lines. We will also study concept of axis lines where support turns into resistance and vice versa. How to identify important axis lines is important. These axis lines provide trading opportunities. These are important aspects of market structure. Then we will also understand break of market structure based on these concepts, which will help us to identify change in trend. There is one more form of market structure in the form of higher high higher low formation for uptrending structure or lower low lower high formation for downtrending structure. It is important aspect of market structure and we will discuss it in bar by bar analysis, which will be second section of our phase 1 analysis. We will also see which are major swing highs, swing lows and which are minor swing highs, swing lows. There are 3 different types of swings: major, intermediate and minor. So it will also be very important. Last part of phase 1 will be volume analysis, and it is important aspect of Wyckoff's methodology. We will discuss volume in details. It includes effort versus result principle of Wyckoff's methodology. Once all 3 sections are completed for phase 1, we will discuss our first important trade setup based on this analysis, and we will start practice on this part with mentorship group as soon as possible.